Hi, Kelvin Kelley here with Watson Mortgage. I was thinking about the different loan programs that are available, and there's really just a handful of major programs, VA and FHA. I've talked a little bit about that. But probably the most predominant program is conventional financing. What conventional means is that it's accepted by Fannie Mae or Freddie Mac. Those quasi-government entities that we've all heard of are the ones that set the guidelines, and then if it fits within the guidelines, the loan is considered to be conventional, meaning that it can be sold on the secondary market. Now, with conventional financing, you have the ability to put 20% down and have no mortgage insurance or upfront guarantee fee or funding fee or anything like that, which makes it a pretty good deal. But conventional financing is truly driven by credit score. So a lot of times we find somebody that could qualify for conventional financing, but move them into a different type of product like FHA because the overall interest rate would be lower. See, if you've got a 740 or better credit score, then you can get the best interest rate with conventional financing. But if you've only got a 680 credit score, then you may have to pay 2 points, that's right, 2 discount points, 2% of the loan amount in order to get the same interest rate that somebody that has a 740 could get. Now, the other way it works is instead of paying the discount points, you could accept a higher interest rate. But then if you accept a higher interest rate, which at a 680 credit score would probably be about 0.5% higher, which is pretty significant. That's going to limit the amount that you qualify for because there are maximums of debt to income ratios. So conventional is an interesting animal, but it's not for everybody, even though a lot of people ask about it right up front. Now, with the mortgage insurance elements of conventional, it kind of comes in 2 different flavors. The first flavor is you could put as little as 5% down, and then you'd have a monthly mortgage insurance, which is going to run, and the factor would be 0.78 of the loan amount divided by 12. That would give you your monthly mortgage insurance. But there is a new product available with 5% down. It's conventional financing, but it has no mortgage insurance. No mortgage insurance at all. Not upfront, not monthly. It's actually built into the interest rate. See, the interesting thing, the mortgage insurance element is 0.78 for conventional loan, whereas if you accept the no mortgage insurance product, the interest rate's only going to be about 0.5% higher than the standard conventional. So that's actually a very interesting product. Now, the reality is the no mortgage insurance product will have that interest rate for the life of the loan, whereas the conventional product that has mortgage insurance, after you hit 78% of the original purchase price, that mortgage insurance would fall off. Now, how long does it take for that to happen? 11.4 years. That's a long time. Of course, now with the conventional product, after 2 years, you do have the option of petitioning for the mortgage insurance to be removed. But you'd have to come in at 80% of the current value. So after 2 years, you could petition the lender to, you'd have to pay for an appraisal, and they would determine the current value and then see what the current balance is. And as long as it was at 80% of the current value, you could have the mortgage insurance removed. So really and truly, if you saw appreciation of 3 to 5% over the next 5 to 7 years, and you were making your minimum monthly payment on time, so your balance was coming down, there would be a point in about 5 to 7 years to where you would hit that 80% mark, and then you could have the mortgage insurance removed. So deciding on which of these products to use, that's part of my job, to talk to the customer and find out what their wants, needs, and desires is, and I'd be more than happy to talk to your customer. I'm Kelvin Kelley with Watson Mortgage, and I'll see you around.